Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. Huge show for you today. A special edition of the Weekend Charts called the State of the Markets. I did this a few months ago. People have been asking for an update. So here we go. What are we going to be discussing? Pretty much everything. Stock market, bond market, Fed, real estate, housing, commodities, currencies, crypto, intermarket analysis, and we'll end with the U.S. economy. So let's begin with the U.S. stock market. This has become like a Groundhog Day movie. Almost every other day, we're seeing new highs in the stock market. 47th time today, closing at an all-time high for the S&P 500. Incredible run, one of the strongest years on record. You could really see that in this chart right here. I'm showing you the path higher this year versus the average year. S&P total return up about 24% so far this year. The average year at this point up probably around 5.5%, 6%. So more than 4x higher than the average year. Incredible run. Only 1995 and 1997 have had better starts to a year than this year since 1990. And if we look at two primary reasons for the advance, number one would have to be fundamentals. So let's give credit to earnings here. Earnings set to hit another record high this quarter. We're just starting to see earnings for the earnings season. We had the banks reporting pretty good numbers. We had Netflix reporting a good number. A lot of earnings yet to come, but the expectation is another record high for earnings in terms of S&P 500 operating earnings. So you have that fundamental growth, but more important this year, much more important, has been multiple expansion. You can see that in the chart right here. I'm showing you the S&P 500 price to peak earnings ratio. Highest now we've seen since 2000, about 50% above the historical median. So we're seeing fundamental growth, but expectations are very, very high, leading to multiple expansions. Why are they high? Well, if we look at the expectations for earnings over the next year and change here, by the end of 2025, this is the estimates out of S&P Dow Jones that the S&P 500 is going to have earnings 25% higher than where they are today. So an incredible jump higher is expected. Really, a lot of that coming from the expectation that AI is going to translate into big earnings increases for a lot of the big technology companies. Now, is that going to happen? We don't know, but that's the expectation. That's why you're seeing that big multiple expansion this year. So let's compare the US market with the rest of the world. It's now 16 years and running of US outperformance. You could see here this week hitting yet another record high, the ratio of US stocks to global equities here over 16 years. That's the longest, by far the longest period of US outperformance in history. You can see here in this table of country ETF returns here, US number 3 after Argentina and Peru. So once again, US outperforming the global equity markets. Now, let's talk about large caps and small caps. A few months ago, we hit the highest ratio of large caps to small caps, meaning large caps outperforming small caps by the widest extent since October 1999 during the dot-com boom. Since then, you can see here just a little bit of a pullback. So that means small caps have been outperforming over the last 3+ months. But you can see here on a year-to-date basis, still large caps leading, and you can see the increase in concentration at the top. The top 3 stocks in the S&P 500, still over 20% of the index. It peaked back in July, I think at a little over 21%. We're down to 20.2% here, but still incredibly high concentration in the biggest names, Apple being number 1, Nvidia number 2, and Microsoft being number 3. Now let's talk about value and growth. So similar to large and small, we saw a few months ago, this ratio hit its highest levels in a long time. You got to go back to March 2000. That was the only time this ratio has been higher, meaning growth outperforming value by this extent. You got to go back to the exact peak of the dot-com bubble back in March 2000 to find a higher ratio. Since then, interesting, we've seen value stocks start to outperform. So we're seeing a little bit of outperformance in value stocks, a little bit in growth stocks, but you can see here the trend over the last decade plus has all been about growth stocks and large cap stocks. Now let's talk about the most dominant sector in the last decade. That would be the technology sector. You can see here back in July, hit an all-time high, surpassed the high from back in March 2000. And since then, this is becoming a theme here. You can tell since then we've seen a pullback. So pullback in growth stocks, pullback in large cap stocks and pullback in the tech sector, all on a relative basis to the overall market and to small caps and to value stocks. And this chart really illustrates that factor rotation over the last few months. So since July 10th, we've seen small caps outperform. They're up about 13% here. Large cap value up 10.6%. Then you have the S&P 500, not down, still up 4%, still hitting all-time highs, but lagging now. So large caps lagging small caps, and you can see large cap growth stocks, which have been far and away the best factor over the last decade, actually down a little bit since July 10th. And if we look at the sector picture, you can see here everything up since July 10th, except one sector, that would be the technology sector, down 3%. You can see, interesting, utilities actually strongest performing sector, real estate number 2. So big move higher on that expectation that the Fed is going to continue to cut rates. Of course, they cut rates for the first time since 2020. Back in September, the expectations are going to cut again in November and again in December and continue cutting into next year. So that boosting these interest rate sensitive sectors like utilities and real estate and technology stocks, mean reverting actually down slightly over the last few months. And if we look at the far and away best performing industry group over the last decade, that would be the semiconductor sector. You can see here that relative strength actually peaked in June, so a little bit before these other areas, which peaked in July. And you can see here underperformance, even though the leading stock in that sector, NVIDIA, has hit new highs again this week and has kind of held its own. A little bit of a relative pullback, not a new high in terms of its relative strength versus the S&P 500, but again, holding its own. But you're seeing weakness in those other semiconductor players. So interesting that peaked before the technology sector, before the large cap to small cap ratio, and before growth to value. We saw semiconductors to the broad market peak out and a rotation in the sectors and industry groups over the past few months. And what has been lagging is starting to lead. We talked about utilities, obviously, and real estate, but financial stocks and banks, just a huge bump up over the past few months. You can see here in July, when technology and growth were really pulling back, you saw just the bank stocks explode higher, and they've gone sideways since, but over the past week pushing higher again. And I tweeted out these figures here: 1 year total returns for the major big banks in the US, just stunning numbers over the last year. You get Goldman Sachs up 74%, Citigroup 63, Bank of America 63, Morgan Stanley 59, Wells Fargo 57, JP Morgan Chase, the biggest bank in the world, 55%. Regional bank stocks underperforming the big banks, but still up 50% over the last year, and all of them outpacing the S&P 500, which was up a respectable 35%. So very interesting equity market going on. We have S&P 500 still hitting all-time highs, but a rotation within that where you're seeing value stocks start to outperform, small cap stocks outperform, and the areas that have done the best, growth stocks, technology, semiconductors, starting to pull back a little bit on a relative basis. So if you're looking at your portfolio, trying to figure out how to be positioned heading into 2025, reach out today at Creative Planning. Go to creativeplanning.com/Charlie and schedule a call with a meeting with an advisor, and you're going to get a free wealth path analysis from us. And with that, we're going to look at your portfolio, making sure it's diversified, making sure it's going to meet your goals and needs for the future. We're going to give you a retirement roadmap, proactive tax strategies, and do an insurance and estate planning review. So go to creativeplanning.com/Charlie. I'll have the link in the show notes as well. At Creative Planning, we have over $325 billion in assets under management and advisement. We're in all 50 states, and we're here to help. Reach out today, creativeplanning.com/Charlie. Okay, let's switch gears, talk about bonds and the Fed. The bond market, unlike the stock market, which has been hitting highs every single week pretty much this year, the bond market is still in its longest drawdown ever. This is now 50 months and counting for the bond market. Now, it has rallied a good deal over the past few months, one of the biggest rallies we've seen in history, but still here you can see the drawdown down 5.8% from its peak back in 2020. So this is likely to continue for a little bit longer at least, but certainly been better for the bond market over the past year. And you can see that in this table right here. Very strong returns for bonds over the past year. And year to date, we've seen a little bit of a separation here with credit sensitive areas like high yield bonds and leverage loans really outperforming, and duration. Really, this is just in the past few weeks where we've seen long term yields rise a little bit, duration underperforming, with things like TLT actually down on the year. But over the past year, everything's been up in unison. Look at the aggregate bond ETF here, AGG, up 11.5% over the past year, 3% year to date. And if we look at that credit sensitive areas that, as I said, have been really leading year to date, we're seeing just rapid tightening in credit spreads. So this is the spread between what high yield bonds have as a yield and risk-free treasuries of a similar duration. You can see here tightening. Now the tightest we've seen since June 2007. So of course, everyone knows markets peaked back in October 2007, but we haven't seen spreads this tight in terms of the credit market on the high yield end since June 2007. So a lot of complacency. And really, this is just the expectation of bond investors saying there's going to be very few defaults going forward, and therefore I'm not going to demand a very high spread. So very little fear in the bond market right now in terms of high yields and also investment grade bonds. You have to go back even further to find spreads this tight, 0.84% above risk-free treasuries in terms of investment grade bonds. That's the tightest we've seen since March 2005. So very tight credit spreads. And what we're seeing here in terms of the yield curve is a very different picture from the past few years, because we now have a positive yield curve, at least part of it positive again, with longer term treasury yields yielding more than shorter term yields in terms of the 10-year and the 2-year. You can see here 10-year at 4.09%, 2-year at 3.96%. And we had the longest inversion in history where the opposite was true, where shorter term yields were yielding higher than the 10-year. That was a real strange situation that persisted for a real long period of time. And now we have yields back in positive territory. What's driving that? Well, shorter term yields moving down fast in expectation that the Fed is going to continue to cut rates. So you can see here, past few months, big move down in 2-year treasury yield, now back below that 10-year treasury yield. And I've talked about in the past, but what we looked at is the past 5 times that this yield curve went from being inverted for a long period of time and then went back to positive territory. The last 5 times that happened, you saw a recession in the US within the next year. I think 13 months was actually the longest period in terms of the lag between going back in positive territory and there being a recession. So the big question, we'll talk about this in the economy section, is are we going to start seeing a slowdown in the US? But is the whole yield curve back in positive territory? No, not exactly. We don't have the 10-year minus 3-month spread back in positive territory. We still have the 10-year here at 409 and the 3-month well above it at 474. And why is that the case? Well, the Fed completely controls the short end of the curve. So the Fed's going to have to cut interest rates a few more times before this likely shifts into positive territory. And that is very likely to happen in terms of the rate cuts in November and December. So by some point, perhaps by the end of this year, early next year, we'll likely see this turn positive as well. And on a year-to-date basis, what the story has really been in the treasury market is short-term yields coming down because the Fed is cutting interest rates, but longer-term yields, and this is very interesting, actually moving up a little bit. We're seeing the 10-year entered the year at 388, now at 409, and the 30-year at 403 to 439. So I talked about this in the last week in charts. Why is this happening? Well, you're seeing actually, since the Fed has cut interest rates, you're actually seeing inflation expectations start to go up. And what the expectation, I guess, is that the economy is going to be stronger because of these rate cuts. That's going to lead to higher inflation. And then we also have the debt picture, where a lot of US debt is being issued. So a lot more supply coming into the market because we're seeing that national debt really a rapid increase over the last month. And that's likely driving this as well. So just because the Fed is cutting short-term rates doesn't tell you exactly what's going to happen on the long end. And we've seen that so far with long-term yields moving up. And that's why, if you're wondering why mortgage rates have actually gone up over the past few weeks since the Fed has cut interest rates, well, it's because these longer term treasury yields are moving higher. So what is the expectation from the market right now in terms of the Fed, well, it's exactly aligned with what the Fed's own projections were in their September meeting, which is to say they're going to cut another 50 basis points by year end. And then next year, they're going to cut about 100 basis points by the end of 2025. And then they're just going to settle in that range. Now, is this likely to play out this way? Almost certainly not. It's going to change with every data point. You're going to see these expectations change. But in terms of the November meeting, I think there's a very high probability the Fed does 25 basis points. Look at here, 92% is the expectation being priced in right now. So I think the Fed doesn't want to do another 50 basis points. I'm not really sure why they led with that to begin with, but they did the 50 basis points. Now they're going to pull back, do 25 in November. And the expectation is they'll do another 25 in December. And then we'll see what happens going into 2025. It's going to depend on economic data, what happens with the unemployment rate, what happens with inflation. All of those factors are going to drive what the Federal Reserve does. But if you look at this chart right here, this is why the Fed is cutting rates, or it feels like it can cut interest rates. This gap between that Fed funds rate and core PCE inflation, which is their preferred measure of inflation, you can see here, the gap got to its widest levels since 2007. And so the Fed is saying we have room to ease here. We're confident that this PCE, it's not down to 2%. And I've said the Fed should wait until it gets down below it. They're not on board with that. They're saying we need to start cutting interest rates now. And we have enough room to do so. They're confident that it's going to get there by next year. And so they're starting to cut rates now. So what we're going to see likely 25 basis points in November, another 25 in December. And then for 2025, going to be entirely dependent on what happens with the economic data and inflation. All right, let's switch gears, talk about real estate and the housing market. So similar to the bond market, real estate investment trusts have not fully recovered. They're still in a drawdown, still down around 6.6% from their highs a few years ago. And if we look at real estate relative to the S&P 500, you can see here over the last decade, underperforming the VNQ ETF, but over the past few months, outperformance. So similar to financials, bank stocks, real estate as well, outperforming. Certainly the idea of interest rate cuts seem to be helping this ETF relative to the S&P 500. And if we look at the housing market here, it's just been an incredible run higher over the past few years, unrelenting, unexpected in terms of mortgage rates went from under 3% to about 8%. And you had home prices continue to push higher, continue to hit record highs. You can see here, this is the US Case-Shiller National Home Price Index, still up around 5% over the past year. Housing affordability remains near record lows. So you have this situation where home prices are far exceeding the increases in incomes. And this is going on across cities across America, certainly areas in Florida leading the way. Biggest gap, I would say, between increases in home prices and incomes, but everywhere it's outpacing incomes. If you look at the 20 city index from Case-Shiller, up 53% over the past 5 years, you have wages up around 20%. So nowhere near keeping pace with these rising prices. And what that's causing is what I call the affordability gap here, where there's a huge gap between what people can afford based on their incomes. If you look at the median household income in the US, 85,000 now, and we have the money that you need to buy a home would be around 120,000 if you're using 30% of your annual income. And that's a huge gap. That's a 40% gap. So simply unaffordable. The average house is simply unaffordable to the average American now if they were to buy it today. The good news in terms of the housing market, because supply has really driven a big part of this, very low supply driving prices higher, despite the fact that demand has come down. The good news is we're seeing slowly supply come back into the market. It's actually, if we look at listings out of Redfin, up 16% over last year's levels, about 1 million listings today. So moving in the right direction, but you're going to need to see a lot more of this to create more of a balance between supply and demand and keep a cap on those rising prices. Because what you want for the housing market is to become more affordable based on incomes. And we haven't seen this gap. You can see here, it's even bigger than it was back during the housing bubble in the mid 2000s. So this is an unsustainable gap. The question is, how is it going to be closed? Is it going to be closed over a long period of time, where home prices go sideways and incomes catch up to those prices, or is it going to be closed with prices coming down? That remains to be seen. But if we look at rents, completely different story than the housing market for purchase. Rents are becoming more affordable every single month. You can see here, nominal rents actually peaked back in 2022. On a year over year basis, we're seeing declines for over 16 months now on a year over year basis. So lower asking rents. And if we adjust rents for the increase in wages, you can see here, most affordable it's been if you're looking to rent an apartment since 2021, and actually a better place than we've been going back the last 7 years. Look at 2017, we're in a better place now. And the big thing driving that is there's much more supply in the rental market because you had this huge multifamily construction boom, which led to a lot more supply. And that's still coming on the market when these units are being completed. And so you're seeing higher vacancy rates and higher supply there is causing the landlords not to raise prices as much. And we're actually seeing, as you saw on that chart, lower asking rents over the past year over year now for 16 consecutive months. All right, I want to move on, talk about commodities here. First, let's take a broad look at the commodity ETF that first started in 2006. This is the first commodity ETF that started trading the DBC ETF. You can see since its inception, essentially has done nothing since 2006. It's at the same price it was back then, but there's been big booms, big busts. If we're looking at 2008, huge surge higher. That's when crude oil peaked in the middle of 2008. You can see the crash after that. If we fast forward to 2020, that was the all-time low. Of course, after COVID hit, you had crude oil futures actually go negative, and this thing was tanking. Then you had a huge rally out of that, and really over the past year and a half, 2 years, just going sideways. But if we look within that, the past year, we've seen many commodities up strongly and many commodities down. For the U.S. consumer and for inflation, these things in the red here have been very, very helpful. If we look at gasoline down 13.9%, we got crude oil down 20%, heating oil down 28%, natural gas down 23%. So all of these things helping. You got the ag commodities like corn, sugar, soybeans down over the past year. So all that helping with the inflation stats. On the other side, you have industrial commodities starting to push higher here. Aluminum up 20% year over year, copper up 20%, zinc up 28%. Then you have, of course, precious metals, gold and silver, 38% gains, both of them over the past year. And if we look at gas prices, this is what people focus on. Obviously, it impacts the day-to-day life the most. And gas prices actually down 10% over the past year, which again has been helping in terms of CPI, bringing CPI down to 2.3%, lowest levels since early 2021. If we take a look at gold versus broad commodities here, you can see gold really swinging back and forth in early stages of COVID. Gold moving higher. Obviously, had other commodities like crude oil crashing and the relative strength of gold pushing higher. Then you had broad commodities really outperforming gold with the recovery in crude oil, recovery in the economy, pushing lower. And then over the past year, you can see gold really taking a strong leadership position, outperforming the broad commodities index. So let's talk about the last 10 years. Last 10 years, U.S. equity markets far and away best performing. Major asset class, 270% increase here. We're looking at gold here, up 111%, and that broad commodities ETF up 9%. Okay, number 5, let's talk about currencies. Story continues for the US dollar. King dollar, this is the dollar index ETF, UUP. You can see up and to the right, almost back at all-time highs again. Two biggest components of the dollar index are the euro and the yen. You can see the euro here over the last 10 years, weaker euro. Year to date, kind of sideways. And the bigger story year to date has been the yen. Big decline in the yen over the past decade. This year, those declines continue. We had that big spike higher with the reversal of the carry trade, but overall, still a weaker yen. Emerging market currencies, you can see here, a big rally over the past year. Emerging market stocks starting to do better as well. Tends to be a correlation there between the currencies and the equity market, so something to watch there going forward. If we look at the reasons why the dollar index continues to be strong. Well, the two biggest components again are the euro and the yen. If we look at the differential in central bank policy, you can see here big difference in terms of Bank of Japan, still much, much easier than any major developed central bank. They did come off of negative interest rates. They're at 0.25% here, but you can see here big negative real interest rate. So if you subtract the 2.5% inflation rate, negative 2.3%. So still very, very easy policy. The expectation is they will have to hike again at some point, but for now, much easier, of course, than the Fed here, which is still positive 2.5%. Obviously, that's expected to come down with the rate cuts as well. If we look at the Eurozone, the ECB is at 3.25%, 1.5% spread. So in terms of monetary policy, still the Fed is the tighter of these three central banks, and that's helping the dollar remain strong. Another factor I would say is the fact that the US economy is growing faster than most developed economies, certainly faster than Europe and Japan. You can see here US growth over the past year, 3% increase in real GDP growth. If we look at countries like France here, 1% increase, Italy 0.9%, UK 0.7%, Sweden 0.5%, Germany flat, and Japan negative 1%. So all these factors helping the dollar remain strong. So let's talk about crypto. And it's been a banner year for crypto, but really the story has been mostly about Bitcoin. Bitcoin, you can see here, recovering from that huge decline that it had in 2022 and hitting new all-time highs. You can see here Ethereum never getting back to its previous all-time high, and a big differential between the two now on a year-to-date basis, with Bitcoin outperforming, Bitcoin taking share from the crypto market. You can see here the shaded area in blue, Bitcoin becoming bigger and bigger as a percentage of the market. Now over 50% of the value of crypto is just in Bitcoin. And most of Bitcoin's return this year has come early in the year. So we had that really parabolic spike higher after the issuance of those ETFs, the Bitcoin ETFs. And what we saw was just a incredible move higher, where Bitcoin was hitting record highs pretty much every single day. And we haven't seen a new milestone since March. March 13th here, we crossed above 73,000. We've essentially gone sideways with only one meaningful pullback since then, 33% decline, but it's recovered a good portion of that decline since then, and now not too far away from that record high hit back in March, but at 67,000 here, you can see up 59% year to date, following last year's 156% gain. Okay, let's talk about intermarket analysis, looking at relationships between and across markets. Start out here comparing the US stock market to the US bond market. You can see here up and to the right over the past year, stocks widely outperforming bonds. You have the S&P hitting 47 all-time highs so far this year. And as we talked about, the bond market still below its high from 2020. Looking at here the correlation between stocks and bonds over the last 3 years. A few months ago, we were saying this hit a record high of 0.71, which basically means most of the time stocks and bonds are moving in the same direction on a monthly basis. But over the past few months, we've seen a little bit of a change in behavior, especially with the correction in the equity market in early August, where we saw the equity market going down sharply and bonds rallying as interest rates fell. So really, the relationship here seems to be changing, especially with the Fed easing monetary policy, with inflation coming down, where the biggest fear for a few years, why this was so correlated, the biggest fear was rising inflation. And because of that, during equity market corrections, you had stocks going down and bonds going down because interest rates were rising during those corrections because of fears about higher inflation. And this seems to be changing here. We're probably in the early stages of a shift in this correlation starting to move lower again. So let's talk about bonds and stocks over the past 3 years. So we're saying stocks and bonds have been highly correlated, but correlation doesn't equal returns, is what I always say. You have to look at it separately here, and we can see that with the stock market up 37% over the past 3 years, while the bond market's actually down 5%. So just because they've been moving together most of the time on a monthly basis doesn't mean they end up at the same point. And we can see that in this chart pretty evidently. So let's talk about stocks versus commodities. You can see here stocks had been rallying against commodities heading into 2020. Then we had the surge higher after COVID hit. As we talked about, crude oil futures went negative. Then stock market starts to underperform commodities. That accelerated in the beginning of 2022 as stocks went into a bear market. Meanwhile, you had commodities spiking, you had crude oil, gasoline going up, and that really was the first quarter into the second quarter of 2022. But since then, stocks have taken a leadership role again and almost back at their previous highs. And if we look at the last decade, no comparison, obviously stocks widely outperforming commodities. With gold, a little bit of a different story here. Obviously, stocks definitely much better over the last 10 years than gold, but you can see the sideways action over the past few years. And on a year-to-date basis, stocks actually underperforming gold a little bit so far in 2024. Bitcoin versus the S&P, this is kind of a funny chart because it really just reflects most of the time what Bitcoin's doing, because Bitcoin's far, far more volatile than anything else. But you can see here the relative strength of Bitcoin versus the S&P 500 actually peaked a few years ago. And if we look at this year, most of the relative strength outperformance in Bitcoin came during that early part of the year when Bitcoin was hitting those all-time highs. And since then, actually, the S&P 500 has outperformed Bitcoin since that peak back in March for Bitcoin. And if we look at year-to-date basis here, number one and number two asset classes, interesting. Bitcoin, number one, 59% gain, gold, 30%. But everything pretty much is doing well this year, with the exception of long-term bonds down a little bit. Got growth stocks up 26%, S&P almost 24%, the NASDAQ 100 over 20% gain once again. Value stocks coming on strong here, small caps and mid caps starting to make up some ground. So everything pretty much doing very well in 2024. But number one and number two, Bitcoin and gold, that's something we haven't seen before. Looking at this chart going back to 2011, these two asset classes being number one and number two. So what's driving that? Well, these are story asset classes. They're not driven by the same fundamentals as the equity market or the bond market. They're asset classes that trade primarily on a story. And the story right now is that the US government and other governments are being irresponsible. If you look at the US national debt, I think obviously this tells the story pretty well, especially over the past 13 months here. We're looking at the national debt increasing over $4 trillion since that debt ceiling was suspended. And this is during an expansion. The economy is still doing pretty well in the US, GDP running about 3% year over year. And we have this situation where national debt continues to go up. We continue to have deficit spending. And the story behind Bitcoin and gold is these are things with limited supply. And whether you believe that story or not, that seems to be a big reason for the advance. The other thing I would say, as I talked about with gold, is the idea that real interest rates falling is good for gold. So gold, its competition is often viewed as the bond market. And if you could park your money in bonds and earn a few percent above the rate of inflation, people will prefer that. And for a little while, that's what was happening. If we look at 5-year real treasury yields, they were over 2.5%. So you could have locked in 2.5% above expected inflation. Now we're down to about 1.6%. You can see the trend lower over the past few months. That's certainly been a boost for gold, less competition. If the expectation is the Fed's going to continue to cut rates, going to cut another 150 basis points, perhaps this real yield's going to continue to come down. I think that's another factor helping Bitcoin and helping gold, because these are things without a yield. And so if there's less competition and the real yield's coming down, it tends to favor those asset classes. Okay, we're going to end with the US economy, and I want to run through a number of charts here, but we have to start with the expansion here, 51 months and counting, and it's likely to go to 54 when we get that real GDP for the third quarter. And the recession really has not come again. So anyone who called for a recession 2022, wrong. 2023, wrong. So far in 2024, wrong as well. And we had a little dip in terms of the growth in the first quarter, and people were saying, well, maybe that's it. Maybe now we're going down. Didn't happen. We snapped back in the second quarter, 3% annualized GDP. And the expectation for the third quarter from the Atlanta Fed, another 3+% growth rate. They're saying 3.4%. We'll see how it shakes out. But if you can see here, the Wall Street estimates have been trending higher. They're now above 2% as well. So very likely that third quarter is going to be another positive number and likely a strong number as well. What's going on in terms of inflation? Well, the Fed seems to be comfortable that inflation is moving down to their 2% target. But if we look at core inflation here, it's still persisting above 3%. Core CPI, 41 consecutive months above that 3% level. That's the longest period of high inflation since the early 1990s. And if we look at this gap since 2020, this is what people are feeling. They're not feeling 2% inflation because we haven't had 2% inflation. We've had over double that since the beginning of 2020. And just because we've come down with the inflation rate to around 2.4%, that doesn't mean that we've erased that above 2% inflation and that high inflation we saw from 2021, 2022, 2023. It's cumulative, right? So it keeps adding up. And for a lot of people, that's painful because perhaps their wages aren't keeping pace with that inflation. Now, if we talk about the consumer pulling back, we have to talk about this chart here because retail sales seem to be slowing down 1.4% over the past year. That's below the historical average, which is about 4.6% increase. But what you have to do with retail sales, you have to adjust for higher prices. We do that in the bottom chart here, and you can see they're actually down 1% after adjusting for higher prices. And you can see for a good part of the past few years, they've been below this zero line, which to me indicates consumers pulling back, at least at the retail area in terms of their spending. Unemployment rate here, very important. Obviously, the Fed looking at this very closely. One of the big reasons probably they decided to cut by 50 basis points. But last 2 months, trending lower again, 4.1%. We got as high as 4.3% a few months ago, but still well below the historical average, was around 5.7%. And we aren't seeing big layoffs so far. So what we're seeing is a rise in the unemployment rate, but not yet to a concerning level where we're seeing big job losses where people are filing for unemployment rates, unemployment insurance. That hasn't happened just yet. The labor market, though, is loosening. A lot of factors pointing to that. We've talked about job openings coming down. This is looking at the quits rate. So percentage of people quitting their job is moving down, lowest since June 2020. So this is definitely a sign labor market is cooling. We're seeing the percentage increase in the number of jobs, although they continue to go up at a lower pace. And taken together, this to me would indicate right now there's more of a balance between supply and demand in the labor market. For over here, when we had a 3% quit rate, when we had an enormous amount of job openings, there was a huge amount of demand and not enough supply, and now we're more in balance. Okay, I want to end, as we always do, with something positive here, and this is very positive for the U.S. economy. This is the most important chart for me to gauge how an economy is doing, and that's the relationship between wages and prices. So how much are wages going up versus how much prices are going up? We were in a very bad place for 25 consecutive months. Now we're in a much better place. 17 straight months now of positive real wage growth, with wages outpacing inflation over the past year by 1.5%. So hopefully this continues. And thanks everyone for joining me on the State of the Markets. Have an awesome weekend. If you're watching this on YouTube, hit that subscribe button for more content just like it. And I'll see you next time on the regular edition of the Weekend Charts.